What if the loudest trade war in modern history wasn't designed to stop China at all, but to distract you while the financial architects of the global system quietly move their wealth to the next power center? From 2018 through 2020, the American public was told a very clear story. The United States, after decades of outsourcing, trade deficits, and industrial decline, was finally standing up to China. Tariffs were rolled out in waves. Hundreds of billions of dollars worth of Chinese goods were targeted. Politicians from both major parties echoed the same talking points. Jobs were coming home. Supply chains would be rebuilt. Beijing would no longer dictate the terms of global trade. The message was loud, emotional, and relentless. And yet, during those exact same years, while that narrative dominated headlines, something entirely different was happening beneath the surface. Quietly, methodically, and without public debate, the largest financial institutions on Wall Street were moving enormous amounts of capital into Chinese markets. Not millions. Not tens of billions. Roughly $4 trillion flowed into China between 2018 and 2020, with the peak arriving in 2020 itself, the most intense year of the trade war. This wasn't a delayed reaction. It wasn't a post-conflict realignment. It happened at the height of tensions, while tariffs were escalating and rhetoric was at its most aggressive. BlackRock expanded its footprint. JPMorgan secured approvals to deepen its presence. Goldman Sachs increased its exposure. The broader institutional investment complex followed along automatically. At first glance, this appears irrational. Why would America's most powerful financial entities move deeper into China while Washington publicly framed China as an economic adversary? Was Wall Street misjudging political risk? Did it underestimate the seriousness of the trade war? Was this simply bad timing? The answer is no. This was not a mistake. It was not confusion. And it was not poor judgment. What happened between 2018 and 2020 was one of the most predictable financial moves of the modern era once you recognize the pattern behind it. The global monetary system does not operate randomly. It does not move based on emotion, ideology, or political loyalty. It operates according to incentives embedded deep within its structure. And those incentives follow a cycle that has repeated, with remarkable consistency, for centuries. Every major reserve currency system in history has moved through the same sequence. Different nations, different centuries, same mechanics. The cycle unfolds in 4 stages. The first stage begins with the consolidation of monetary power. A central institution is created and granted exclusive authority over money creation. Whether through law, necessity, or crisis, the ability to issue currency becomes centralized. This is sold as stability, as efficiency, as protection against chaos. And in the early phase, it works. The second stage emerges when that monetary authority is used to finance government expansion through debt. Wars are funded. Infrastructure grows. Social programs expand. Taxes alone no longer cover costs, but borrowing fills the gap. Because the central bank can monetize that debt, the system appears to have solved an ancient problem. Growth accelerates. Confidence builds. The economy expands faster than before. To most participants, it looks like progress. The third stage begins quietly. Debt grows faster than productive output. Currency supply expands faster than real economic growth. Purchasing power erodes, but slowly enough that it can be explained away. Temporary factors are blamed. External shocks are cited. Structural issues are denied. The system still functions, but the cracks are forming beneath the surface. The fourth stage is the least discussed and the most important. This is the stage where the architects of the system reposition. Capital begins moving out of the weakening center and into the next rising power. This happens before collapse becomes obvious, before confidence breaks, and before the public realizes what is unfolding. By the time the currency crisis becomes undeniable, the repositioning is already complete. History is filled with examples of this exact sequence. In late 17th century Britain, the creation of the Bank of England marked the beginning of modern central banking. The British government, desperate for funds during wartime, struck a deal with private financiers. In exchange for loans, the bank gained the authority to issue money backed by government debt. This innovation transformed debt into currency and allowed interest to be collected on the nation's entire money supply. The results were immediate. Britain's debt exploded, but so did its power. The empire expanded across continents. Trade networks stretched across the globe. The pound sterling became the dominant currency for international commerce. For decades, Britain appeared unstoppable. But as the 19th century progressed, the strain became visible. Industrial leadership shifted toward the United States and Germany. The cost of maintaining global dominance rose faster than revenues. Debt climbed again, and quietly, British capital began flowing outward. Railroads in America, steel production, industrial expansion across the Atlantic. The same financial interests that had fueled Britain's rise were now building its successor. By the time Britain abandoned the gold standard in 1931, the transition was already complete. Financial dominance had moved to New York. Stage 4 had executed flawlessly. Germany's experience after World War I followed the same structure, but at an accelerated pace. Burdened with reparations, the German government chose monetary expansion over taxation. The central bank monetized government debt aggressively. Inflation surged, then spiraled into hyperinflation. Savings were wiped out. The middle class was destroyed. Social stability collapsed. This outcome is often framed as incompetence or desperation. But internal records later revealed something more calculated. Monetary destruction eliminated domestic debts and reshaped political power. When stabilization finally came, it required foreign capital, primarily from the United States. American banks entered Germany to restructure the system, gained influence, and positioned themselves for the next phase. Once again, capital arrived during crisis and exited before collapse completed. After World War II, the United States inherited the role of global financial anchor. The Bretton Woods system tied the dollar to gold and other currencies to the dollar. For a time it worked. Europe and Japan rebuilt. Trade expanded. American dominance was unmatched, but reserve currency status carried temptation. The United States began financing wars, social programs, and global commitments through deficits rather than taxation. Dollars flooded the world. Foreign governments accumulated them. Eventually, there were far more dollars in circulation than gold to redeem them. In 1971, the system broke. The gold window closed. The dollar became fiat. Once again, the cycle moved forward. Now return to the present. On July 6, 2018, the United States imposed its first major tariffs on China. The trade war officially began. The timing seemed decisive. But 1 month earlier, a quieter event reshaped global capital flows. MSCI, the firm that determines the composition of major global investment indices, began including Chinese A shares in its benchmarks. This decision mattered more than any tariff announcement. When a market enters an index, institutional capital must follow. Pension funds, sovereign wealth funds, insurance pools, and endowments do not debate geopolitics. They track indices. Trillions of dollars move automatically. Between 2018 and 2020, China's weight in major indices surged. Capital flowed in relentlessly. By 2020, U.S. portfolio investment into China reached approximately $4 trillion. This occurred while trade tensions were at their peak, not after they resolved. This was not contradiction, it was coordination. While politicians argued publicly, the financial system executed stage 4 privately. Now look at the current conditions. U.S. debt approaches levels historically associated with crisis. The Federal Reserve's balance sheet expanded from under $1 trillion in 2008 to nearly $9 trillion after COVID. Currency supply has grown far faster than productive capacity. Inflation is not an anomaly. It is a feature. And yet the public is told not to worry, that this time is different. That technology innovation or policy tools have changed the rules. They have not. The pattern does not care about ideology. It does not care about nationalism or political preference. It does not care about promises or narratives. When a debt-based monetary system expands beyond its productive limits, currency debases. And when that currency is the global reserve, the architects of the system move first. The trade war, in this context, was not designed to succeed. It was designed to perform, to create the appearance of resistance while financial integration accelerated. You cannot confront a nation economically while your largest financial institutions are embedding themselves deeper into its markets. The contradiction is structural, not accidental. The British public did not realize their capital was building America until after the transition was complete. Germans did not understand how foreign capital positioned itself during their crisis until it was too late. Americans today are no different. This is not about fear. It is about clarity. When you hold assets denominated entirely in a currency undergoing structural debasement, you are participating in the transfer. When inflation is framed as temporary, you are being distracted from its cause. And when reassurances are offered that modern systems have solved ancient problems, history suggests otherwise. The next decade will not resemble the last 30 years. The machine is accelerating. The debt cannot be repaid. The currency will continue to dilute. Capital has already moved. This is not a prediction. It is pattern recognition. The same mechanism that moved British capital to America, American capital into Germany, and global capital out of Bretton Woods is now executing again. While politicians argue over tariffs and headlines focus on optics, the financial system has already chosen its direction. The only remaining question is whether you recognize the pattern while it is still unfolding, or only after the transfer is complete.